3-minute trader tip. 3 critical portfolio considerations for short-term traders. There is lots of advice out there on portfolio setup, particularly for those who are trading long-term, but very little exists for the short-term trader. So as we consider these 3 areas, we will consider these to be critical. At every level, even at beginner level, we should have some foundation rules in place which form part of our plan. And these are based on effective management of margin if we're using leverage trading, and of course your individual capability to potentially have to make multiple decisions at the same time. For example, if the market has a big price movement, we have lots of decisions to make potentially on that big price movement, either adversely or positively. The more trades we have open, the more decisions we have to make, then arguably perhaps those decisions may be not as good as they could be. So it is important within your underlying principles within your trading plan to specify the maximum number of trades you're going to have open at any one time and the risk per trade. Additionally, number 2 consideration is the asset mix, not only within the same asset class, and so by that we mean, to use an example, similar currencies in multiple pairs. So you may have an AUD Japanese yen, a New Zealand dollar yen, and a US dollar yen all open at the same time. If the yen moves adversely or positively, then you could be in a situation where you get 3 positions moving identically or nearly identically, or certainly in the same direction, so extending risk across many assets. This is even more important when trading multiple instruments, which many traders do on MT4 and MT5. So for example, the risk on currencies such as, let's say, the Aussie US, and we've got a long position in copper and a short position in the US dollar index, all will move in the same direction on a particular set of market circumstances. So beware overall correlation and the multiple overall risk that may create. Again, if you can potentially specify this within your underpinning trading rules, that would seem like a logical thing to do. Once you've moved to an intermediate level of trading, you start to look at market risk in a little more detail. And you're more likely to move towards a range of numbers of trades you have open rather than a specific maximum, but also difference in position sizing depending on the level of market risk. So for example, if you have an objective set of criteria that say market risk is currently high, rather than having 5 positions open at any one time, you may choose to limit this to 3. And rather than 2% risk on individual trades, you may limit that to 1. But as suggested, these are based on objective criteria and something you should move towards perhaps, as there is no more dangerous time, theoretically, than when a market changes direction suddenly. By anticipating this, through a judgment of market risk, you can potentially start to wind down some positions prior to this potential market event happening. So what we want you to do is go away and have a look at those 3 considerations and ask yourself the question, are they part of my trading behavior? And of course, as always, make sure your approaches are specified within your plan and measured on an ongoing basis so you can find the right approach for you and your trading as an individual. Trade safe, and we'll see you again soon. Bye bye for now.